Today is the 20th of August, 2026, 10 a.m. CET and 4 p.m. Manila time. This episode will look at Southeast Asia's potential growth boost from the AI boom, unprofessional ECB comments on US tech stock valuations, European households spending less and saving more, and fiscal woes hounding the next Brazil president.
Hello to our listeners. I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgreen, the founding CEO of Lundgreen's Capital.
This is Sound Economies with Mel and Peter, a weekly East Meets West podcast by Lundgreen's Investor Insights. Join us as we analyze developments in major economies and financial markets globally.
Hi, Peter, and hi to our listeners. It's the middle of August. How has the week been for you so far, Peter?
That's been good. We are truly back in business. A lot of stuff going on. Also, markets are interesting. Surely, a lot of also a bit of political stuff going on, as we have also mentioned a couple of times ago. How about you, Mel? How's the week?
We have just wrapped up our quarterly China Fund webinar yesterday. So it was kind of an exciting discussion. Of course, AI played a very much central role in the discussions, and we did share how the initial excitement over AI stocks have kind of simmered down over the past few months, but it remains to be the one of the bigger drivers regarding China equities. And we did also explain how our own China fund is taking exposure towards AI with a bit more cautious optimism. We do observe and we track companies closely, but not everything. We don't just jump at anything that says it's AI. So that's how we do it. And another quarterly webinar will be coming in October. So we invite everyone to stay tuned for the details.
Yeah, that was a good webinar. So thank you for organizing.
We have a lot more to talk about AI today, and actually, well, it remains to be a closely watched segment in the market. It's the shiny new thing. And for Southeast Asia, where I'm at, Peter, there's really this refreshed optimism regarding how AI, the whole AI segment, can potentially lift some developing economies in Southeast Asia much, much higher in the global income scale. There is this analysis that the microchip boom, the rising demand for memory chips, could potentially help countries like Vietnam and the Philippines rise higher into the high income status for economies. So that's a World Bank scale. Both countries have just been upgraded to upper middle income status this year. So that means about a GDP per capita of $4,000. But yeah, it sounds like a dream, but one country is closer to getting that boost than the other. That's Vietnam. It's largely because Vietnam has a much more broad and stronger or stable manufacturing base than the Philippines, especially technology-wise. Their industry sector is also at about 40% of GDP, so that's much broader than the Philippines. And there are already companies, manufacturers of microchips that are positioned or are looking to enter Vietnam as a manufacturing hub. And we're talking the likes of LG, Samsung, and Intel. And they're looking to expand domestic production with the support, with the special assistance of the Vietnamese government. So that's really one boost that could help the Vietnamese economy grow much, much faster than its current pace. For the Philippines, a less robust outlook for how the semiconductor industry could potentially lift growth. The Philippines did join the USS Pax Silica movement. And with that, it means allowing data centers and possibly chip factories to enter the Philippines. It is facing much resistance, however, because there is this hot discussion about how can a country like the Philippines support the demands of data centers when it's so electricity heavy and water demanding, when locally electricity is expensive and water supply is scarce outside Manila. So that's one of the many facets that must be considered as far as how looking at how these countries can really join the global AI supply chain. There is, of course, this drive to join the AI driven growth. It could potentially reshape global economic growth and global economic landscape, but domestically there are more adjustments that need to be done. But it could easily also be the way for Asia to truly dominate the space, but only if they are able to address these concerns.
Yeah, so this is extremely interesting. The semiconductor, the chip sector, with all the aspects, also as on high macro level, as you mentioned, as a sector for the investors, the semiconductor and the chip sector is extremely interesting. Also because there's a shortage. Yeah.
Mhm.
It means that there's one good prediction, that is prices on chips going up. That is the most likely thing to happen. Also, when we look into the comments from the C-level people at also big semiconductor chip manufacturers, and this is a thing that will go on until maybe 2030. It means a lot. What will the next smartphone that each of us needs to buy at some time, the price is much higher, and that is
Mhm.
partially due to the chip shortage. Yeah. So for each and everybody, there's an importance. That is sort of from the investor perspective, even. And then we have, if we link it into one of our really big mega trends
Mhm.
about the globally growing middle class. And not only is it growing, but it's also adjusting to towards a middle class, so to
Right.
say, meaning that the middle class in Germany will lose further in purchasing power, and the middle class in, let's say, Vietnam, as you mentioned, will gain in purchasing power, because these two countries, they will actually also adjust to each other. And this is
Yes.
some of the painful stories for US and European middle class households. Yeah. Um, that is the chip sector grows, and how it moves, how fast it moves. It moves extremely fast, and to the benefit of, as example, Vietnam or other Southeast Asian economies. So it actually also fuels this mega
Mhm.
trend of getting the middle class bigger, but also more, how say, unified in terms of standards of living and household income. This moves much faster than uh, people in general believe, in particular than the politicians understand. But in this podcast, we also have the focus on the investors. Does it
Right.
even surprise investors, this move, this global move? We argue yes, it will surprise, because it's hard to see and to describe the move in just one figure. It's a bigger sort of analysis. So it's
Mhm.
fantastic, interesting, and also as just to mention also the comment on the data centers. Very different discussion, of course, but the data centers for that is needed due to the AI development, because AI actually means much more data that needs to be handled. And that is the
Correct.
impressive thing with AI. Yeah. It's the same we in our small country where I'm
Mhm.
based, Denmark. We have a lot of green energy, and the tech companies, they still like green energy, despite President Trump made how to say green technology and energy less fancy and less attractive, sort of in his view. And but we have the same and the same discussions also on sort of local and province level in Denmark. Do we want to have these data centers? Because it means that there is an ambition about the Danes using green energy. But all
Mm-hmm.
of a sudden, if there are too many data centers coming and consuming the green energy, then there's basically not enough green energy left for the
Right.
households. And that means that price on energy, green energy, goes up. Or we need to limit our usage of energy at all in the private households. And this is getting a bit sort of a bit squeezed around the world. This discussion, and it's interesting that the discussion is around the world. That discussion about data centers, we all want to consume more AI generated and powered whatever solutions, let's call it this way, but it requires a lot of data capacity, and nobody wants the data centers. That is another story. So that should we take the story a bit further even?
Yes.
It is one of the interesting real estate investments is actually into data centers, and that might, if there's a squeeze in that sense of meaning, they will have to pay more, or whatever the cost for data centers will be higher,
Mm-hmm.
or the tech companies will have to pay more. That is a good question, but for investors going specifically for that, a bit special kind of investment, but a real investment that globally is actually a bit on the move and therefore interesting. That is another aspect. So there's a lot of things in the story you have there. Fantastic, extremely interesting. What is your take? Will the Philippines, as an example, will they say, okay, we take the data center because we believe it brings us something good, or will they say it's too squeezed? What is sort of our take on that one?
Far as like literal real estate, like land area, there is
Yeah,
potentially a lot of space to accommodate
yeah,
that, because outside, of course, that should be outside the Greater Manila area.
mm,
The question here is, would it be practical to set it up here?
mm-hmm.
As I said, like it's very expensive. Utilities here are very expensive relative to our neighboring countries. We are not really that high on renewables just yet. We're largely coal driven. And of course, that is not necessarily the cheapest nor the cleanest option. So that is among the factors that should be considered. I think the Philippines would be better off with the chip making part instead, though
Yeah.
the talent and the equipment might not be as ready here as, say, Indonesia or Vietnam, which is probably why we'll get the data center before we get the chip making capacity.
Yeah, if I could choose, I would also go for the chip making. That's
Yes.
for sure. That's also due to our discussion. But let's see, it's interesting, and it is a private household, and also on a macro level a market a mover in terms of income.
Yes.
So it can actually move Southeast Asian economies even faster in a good way.
It's
So
very high value. Yeah.
yeah, so it's really really interesting. Yeah.
Let's step up the discussion on AI, Peter. On the other hand, regarding this optimism in Asia, there is this emerging sentiment about potential correction in US tech stocks. Of course, that
Mm,
includes the AI leaders globally. We were talking about a correction, an upcoming correction in US valuations months
mm.
ago, but we did say that it seems that the market remains excited about the sector, and now the discussion is live again.
Yeah, that and sort of let's say one contribution came from a very very interesting source, and that is it was out Monday as the 17th of August, and that was a blog post on the from the ECB staff. Now,
Mm-hmm.
this is sort of a sort of a semi interesting thing, because it is basically a sort of on as a to be found on the as a, it's ECB as the
Mm-hmm.
website, but they do have they do actually have sort of a so-called blog post now, and that is not an official ECB opinion, but it comes from the staff at
Mm-hmm.
as some economists or whatever, and I will say as we it is well known we have a, let's put it a bit sort of saying, critical view on the ECB and how they handle the job as a central bank. And that is, of course, a bit worrying, because it's one of the absolute major central banks in the world. But we still reckon there are a lot of employees there that are really good at the job and are really interesting. We respect a lot, so that is important to say. But as an institution, they are too politically influenced. But now and then we have these blog posts, and this Monday the discussion is about the tech stock valuation.
Mm-hmm.
And when I saw sort of the story, I saw what is the background here? What is the staff trying to tell us something different? Because there is a link from saying, okay, they're worried about, in particular, the very big, well-known tech stocks, big seven, like
Facebook,
Facebook,
Amazon.
big
Yeah.
seven, Amazon, and that's and sort of linking, saying, okay, that's most Europeans, the way they are exposed into these tech stocks are basically via pension funds, more than in private savings. So I thought, okay, are they trying to say that we have a pension fund problem in Europe? Sort of they're underfunded or could be at risk or whatever. But basically not. I was, as they do the link and say also, if you look into to many savers who are buying the global MSCI index fund and ETF, that they're heavily exposed to the big tech companies, actually, because it simply makes so much out of the index. So there's a worry about saying, okay, a downturn on Wall Street based on a tech stock sort of correction could also hurt European savings in that way. Because, as they rightly say, if New York goes down, as Wall Street goes down 25%, the European stock exchange, they will also go down. As that is unavoidable, regardless of the reason why Wall Street would dive lower. And should it only be the very big tech stock companies, it will still hurt the rest of the world. Despite Europe do not have any significant tech companies at all, to be honest. Yeah. So the block, and this is what I'm circling with, is it has got a lot, as the blog post, it has got a lot of harsh comments, because it is apparently more a worry about the absolute valuation of tech stocks. What it completely neglects is that we have seen in earlier this year, we actually saw a very significant sell-off in some of the sub-tech sectors, particularly in the US. And that is also in the sort of semiconductor tech sector and these chip producers. We actually saw in some of the subsectors a 40% sell-off in US in these subsectors. So there has actually been a pretty big correction already this year in some, but not necessarily so visible in Google and Amazon and Meta or Facebook.
Yes.
The blog also refers to, let's say, the very the extreme boom back in the train or railway boom in the 19th century. And of course, it also includes the dot-com crisis. Now, in my view, it is completely hopeless to compare today's tech sector with the railway boom in the 19th century. The world has changed so much. The economic world map in the 19th century was very concentrated on a few economies, like US, European economies, whatever. Today, the global economic map is a much bigger portfolio of economies across the world that moves and behaves in different directions. And any sort of shock, crash, or sector downwards direction or sell-off will be absorbed by this fantastic globalization we are seeing in the economies today, and even compared to when we had the dot-com crisis in 2000, 2001. And if we compare today with the dot-com crisis, I would say I explored it very close myself. Also due to the company where I was working at that time, Dresdner Bank, that was owned by Allianz, a German insurance company, that was really down in the knees due to the dot-com crisis. At that time, I would say 19 out of 20 .com companies, they were hot air. Today, there's not the same kind of hot air. Of course, some AI companies are priced way too high. That happens in any upturn. But can the general market absorb the downturn? Yes, it can. What happens if the big sevens, they drop 25%? Would I, under the current circumstances, would I buy or sell after a 25% drop? I would clearly buy, because these tech companies also, they represent infrastructure, global infrastructure that is needed. You could say even Facebook, but we can be critical towards Facebook Meta on a long-term perspective. But a company like Google, it is fantastic global infrastructure they deliver.
Right.
And this is completely different. The short or whatever long conclusion from here, the blog post from it is from staff at ECB. They should never do that. It is and actually they end up saying in the blog post that it can be that tech stocks, they go lower and then they go up again. That can only be seen after, when in the future. This is as we are talking about comments that are very unprofessional. It confirms one big worry, because we can refer to the IMF comments from last year, from the chief of IMF, that warned against private credit, and also linked into it could spill over with a negative effect to emerging markets. Since then, emerging market has never been that bought. These kinds of institutions, IMF and central banks, they should stay away from doing investment advisory. But it discloses very, very clear that they don't understand the market. They simply don't understand the financial market and the forces, and what is maybe arguing for very high price earning. Yes, there are explanations. So the only central bank that respects the market is actually the US Central Bank, Fed. But they will never ever come up with this kind of comments. They simply respect that the market is a market, and the market decides, and it's the biggest force. You shouldn't try to change it. The only way, if you look into the Fed, just the last comment on this long story, but it is impressive and worrying that a central bank actually exposes it. Some of the Fed regional centers, they come up some interesting, a bit maybe official line, and that is the Fed in San Francisco. They do publish a lot of interesting views, and they were to look into. They're not quite in line with the sort of Washington Fed official line, but anyway, either they will never come up with this kind of investment guidance. And this is sort of the thinking about this kind of blog post. It took a bit of time. We need to give it time, because it is extremely important. It shows us some signals about the missing understanding of the financial markets among some central banks. Big worry, and it deserves a comment. But of course, the blog post is interesting to read in that perspective, I think.
It gave us material to discuss, so it's very interesting indeed. But what strikes me, Peter, is there's this other piece of information coming out also describing the European market, and that's how European households are saving much more even before pandemic era. So there's really this very high level of nervousness, and the data is saying that the saving ratio of European households is at 14.3% versus a historical 12.5% average. So these are people literally holding on to their cash, and they're refusing to spend as they do, which is a recipe for a further consumption and GDP slowdown for Europe.
Yeah, and now we are back in sort of a good old macro economic and data.
Yes.
That we can sort of discuss and try to relate into how should we think as investors in the financial market. How do we what do we think at Lundgreen Capital? How do we adapt to this? And it is also data been out this week from partially Eurostat, the official statistical office for the EU area. Now it shows it actually shows that, playing a bit towards US again, maybe with a GDP growth in US this year on 2.3%. This is actually okay. And actually also better than we would expect with Trump in the lead. To be honest, we need to say that we have Eurozone growth, if they're lucky, 0.9, and we are seeing sort of the low growth area, Germany, much lower. Yeah. If the Europeans would consume as the Americans, and this is a very typical classical picture that has been going on for decades. If we were consuming like they were doing, our GDP growth would also be like 2.5%. Are Europeans more savers than Americans are? Yes, we are, very classically. And we also see the same pattern in China.
Yes.
But what sort of is interesting, and what sort of the data is disclosing is they're trying to say that the time before the COVID-19 pandemic, European savings has gone up in most countries. Very interesting is, in a small economy like the Greece, the savings ratio is actually scale going down. And this is because the economy is progressing. This is interesting. And people are working more. People are now working up to 44 hours per week, but they're spending more. Right? As the economy is moving forward. Fantastic. They're doing a fantastic good job in Greece. This discussion about how much is the households reserving for uncertain times is particularly interesting in the season we enter now, because now the budgets for next year are up for discussions. The fiscal budgets in each and every country. And what will happen? What is happening here? And we see again also a bit in China. What will happen if European governments are copying a bit what is going on in some Asian countries where there is more tax relief, as a simply giving more out of the current earning to be managed by the households themselves, instead of absorbing in tax, and the government is managing what you earn. And that could very likely, this would be some of the sounds we would like to hear when we look into could there be some economic zones, countries in Europe next year trying to free up the economy a bit more, because that is interesting for investors. That would probably, we argue, it would give households more comfort in spending more. But the trick is they will also spend more of what they are holding back today. So of today's revenue their households have, they have a increasing saving ratio. But if they had even more and had a bigger say on their own earnings, they would also scale back the current increased household saving. So there will probably be a double up effect on spending. If people just had a bigger say about what they earn themselves. And we're not even talking about increasing the working hours. Now, these sort of a bit alternative thinking about what to do to get the European economy growing again, we would listen for, and we would really say, okay, now that is interesting as from an investor perspective. This is what we think is good. Yeah. Basically, how to solve the problem with a too high saving ratio in Europe, because it might be simply too high, as people are too risk averse, the households. So yeah, this is a season coming into about the budget we're looking for.
Yes. So also something that we are looking out for closely, Peter, going into the South American region, one of our favorite markets to watch is Brazil. And they are also having these discussions about how the fiscal budget has to be allocated. How is it managed? They do have an upcoming elections just 6 weeks from now. So it's going to be it's currently a four-way race, though it's really a close race between two leaders. So President Lula, incumbent, is seeking re-election. He's left-leaning and he's aging. He's 80 right now. And then you have his closest contender is Flavio Bolsonaro, the son of the imprisoned former president Bolsonaro. So it's kind of a showdown And interestingly, the incumbent finance minister has spoken up that one of the things that should really be the biggest priority of the whoever of them wins would be the fiscal pressure that Brazil is facing right now. So they're at 79% of GDP debt as of last year. The budget deficit is at 8%, so that's very sizable, especially for an economy. It's a big economy. It's the biggest in the region, but also it's quite painful, especially when you're facing high interest rates. They're at 14%. Inflation is not coming down as fast as maybe say in other countries. So do you do more stimulus measures to keep the purchasing power of Brazilians up? Do you offer more fuel subsidies because fuel remains priced high? But that would also carry a lot of fiscal concerns that could make it unmanageable. And of course, you don't want to do that. You have to learn from the experience of your European counterparts, where if you do hand out so much in social benefits, it is bound to catch up with you. You would have to pay for it. The government has to, whether it's more borrowing or raising taxes. It's easy to say efficiency in government spending and efficiency in tax collections, but it's not as easy to implement. So that's what we're also watching out for. So October 4th would be the presidential elections. The unique thing in Brazil is that if you don't get a 50% or higher vote, you have to do it all over again. So if we are looking at a potential re-election or like re-voting
Second,
if they
second
don't
round.
get it.
As what we are a bit concerned about is if it looks like business as usual, then we are really concerned, because business as usual is, as you say, 8% government deficit and
Yes.
ballooning debt. Yeah, that's the only thing that's not that shouldn't happen. So it's an important economy. So
Yes.
we'll keep an eye on for sure. Yeah.
Let's wrap up this very in-depth episode, Peter, with our usual outlook for the regions that we cover. Of course, clouds outlook-wise, there remains to be clouds in the horizon. For some people, that might be the AI scare and the collapse in
Yeah.
valuation. We don't share that view. It is a correction, not a collapse in equity valuations for tech, particularly for AI. We monitor it, we look at it, but it is not a cause for concern or a cause for panic as far as we're concerned.
So, no, as actually today represents quite good our maybe our global outlook. We see more sunshine than anything else. Yes, the clouds are there. Corrections can be absorbed by other sort of forces when we look globally. So we prefer to stay overweight risk still, and that is across the asset classes as we usually mention. So no changes.
Thank you, Peter, and thank you to our listeners.
Yeah, thank you for listening.
Thank you for tuning in. As always, we keep a watchful eye on market shakers and movers. Catch the next episode of Sound Economies with Mel and Peter, a podcast by Lundgreen's Investor Insights. Available on Spotify, YouTube, and wherever you listen to podcasts.
Lundgreen's Invest has secured a historic quadruple exit for its high-tech defense fund. Following the sale of 4 investments to the Danish defense company Omni Capabilities, the fund's value jumped by as much as 40% in just one day. The good news? This evergreen fund is officially open to new investors with an exit possibility every 6 months. Visit lundgreensinvest.com to know more about this co-investment opportunity.
Lundgreen's Capital has been in the business of investment advisory and wealth management for over a decade, with our high-performing and multi-awarded funds to show for it. We're taking this to the next level through an IPO in 2 years. Join us in this journey. Visit our website to learn more.